I was able to secure $38,000 from first-time home buyer programs where I didn't have to take no money out of my pocket besides that $3,700. First off, we're going to talk about credit, okay? This is one of my areas of expertise. So I'm Ron Curtis. I'm a financial literacy coach. I teach people how to turn credit into cash. I know that sounds cliche, but what I do is I'm a passive income coach, and I teach people how to turn liabilities into cash flowing assets, all right? So I'm going to ask one person, what is your definition of credit? It's a tool that allows you to pretty much leverage assets or leverage money, low interest money to acquire cash flowing assets, all right? And that's my whole goal today, to teach you guys about that. So it's breaking down your FICO score versus your Vantage score, okay? So your Vantage score is that score when you log on to Credit Karma. You'll see a score from TransUnion and a score from Equifax, okay? Your Vantage score is pretty much a score that if you want to get approved for a credit card or a small loan. But if anybody in here ever went and got approved for a car or a house, they pull something called your FICO score, okay? The biggest difference between your Vantage and your FICO score is the way that it's calculated. Your FICO score is calculated more aggressively and is weighted different. About how your credit score is calculated, your FICO score is broken down into 5 different parts. So the most important part is called your payment history, okay? That's 35% of your score. Biggest thing with that, you never, ever want to miss a payment. The reason being is because once you miss a payment, whether it's $1 or $1,000, your score can drop 60 to 100 points from the break, okay? So what I tell people is, and all my clients, I advise you all to set all of your payments on auto pay. You know, these days moving fast, September just flew by, and the days can get ahead of you, so set up those auto payments, okay? The second biggest impact and factor of your score is called your revolving credit or your credit utilization. If you guys have Credit Karma, when you running balance up on your credit card and you go over 30% of what your balance divided by your limit is, that's your utilization, it can cause your score to significantly drop, okay? General rule of thumb, you want to keep each and every last one of your credit cards under 30%. Once you go over that 30%, the banks and the lenders penalize you, okay? I'm not saying if you have a $1,000 credit card, you need to go pay $900 for something you can't. What you want to do is make sure before that statement date that you pay it down below 30%, okay? Under 10% is ideal. The next most important factor is your credit age. That's how long you've had credit on your credit profile. That's 15% of your score. Biggest thing with that is you never, ever want to voluntarily close out a credit card, because once you do, it'll wipe away all of that positive credit history and it'll cause your score to drop, right? A lot of times with retail cards and regular credit cards, if you don't use them for a long time, usually 12 to 18 months, they'll close out due to inactivity. So I always recommend people, you know, put a Netflix, put a Hulu, put a bill on a credit card and let it go every month and just have an automatic payment so it can pay it down, okay? The next factor is called your revolving, or your total credit, your credit diversification. So that just means lenders want to know that you know how to manage different types of credit, okay? So they want to see you have some major credit cards, 2 to 3 credit cards. They want to see you have some retail cards at Macy's, Nordstrom, Saks Fifth, Sam's Club, Home Depot, Walmart, things like that. And then they want to see that you have different types of installment accounts on your credit profile. An installment account is pretty much something that you make payments on monthly, so like a student loan, a car note, or something of that nature. And then last but not least, your credit inquiries, that's 10% of your score. Pretty much there's 2 types, there's a soft pull and a hard pull. Soft pulls don't affect your score at all, but hard pulls do. And the way that you differentiate the two is, a hard pull is anything you can get approved or denied for. So if you go on myfreecreditreport.com and you pull your credit, that's a soft pull because you're not applying for anything. But if you go to Best Buy and try to get that 55-inch TV on credit, that's a hard pull, okay? Every time you apply for new credit, it's a hard pull, so don't be scared to do that. It'll drop your score about 3 to 7 points, and it'll stay on there for 2 years. But once you go apply for that new credit and that new $1,000 credit card hits your credit profile, and you make payments on time, that's gonna help increase your score, all right? Okay, so we're gonna talk about conventional versus FHA, okay? So when you go buy a home, there's pretty much 2 types of loans that you can go get. You can get a conventional loan, which is usually around 3 to 3.5% down, or you can get an FHA loan, which is about 3.5% down as well. Biggest thing you wanna know, with the FHA loan, you have to pay something called principal mortgage insurance, which is PMI, for the life of the loan, okay? But with a conventional loan, you only pay for about 20% of the loan. So let me give you guys some context. I had a conventional loan, okay? Those are usually for people who have good credit. And FHA loans are usually for investors or for people who don't have such good credit scores, okay? I was able to leverage a first-time homebuyer program and not have PMI for the life of my loan. But if I did, I would have an extra $150 to $180 a month on my mortgage, okay? But with an FHA loan, you have to pay that for the full 30 years or however long your term is on that mortgage, okay? So when it comes to credit scores, you know, most people think you gotta have an 800 credit score to buy a house. That's not true. With FHA, you need a 580, and with a conventional loan, you need a 620. So there are options out here for you guys, all right? So that's pretty much conventional and FHA. First thing you want to do is, you know, understand what your financial situation is. You know, understand how much money you spend each month. You want to know your credit score. And once you do that, you want to go get pre-approved. You want to go to a trusted lender. You can vet lenders through realtors. You can vet lenders through Google or just from word of mouth. And what that pre-approval letter does, it shows you how much home you can afford each month, okay? Once you get that, then you want to go lock in with a realtor. A realtor will be able to help you with your home buying process. Most realtors aren't even going to take you serious until you get that pre-approval letter because they get paid on the back end of the deal. And if you don't come showing how much money that you can go, how much home you can go purchase, they're not more than likely going to shop with you or rock with you, all right? After you do that, start going to look at homes, okay? You can go look at 100 homes. Your realtor's job is to show you as many homes as you want. This is pretty much the biggest investment you ever make, most people make in their life. So you want to take your time with it and not rush it. So once you go view those homes, then you'll submit offers on the homes, okay? In this market, like the guy from Thumb the Yard said, it's very competitive, especially last year in COVID. Some houses have 30, 40, 50 offers on it. Once you're blessed enough to win an offer, then you pretty much put a contract on the house. Once you put that contract on the house, it has contingencies, such as a home inspection contingency, such as appraisal contingency, and other things to protect you as a buyer, just in case the deal falls through. Once you win that contract, you also put something called an earnest money deposit down. That's kind of like a good faith gesture to like, look, I'm gonna go ahead and let y'all hold this money, put it in something called escrow. It's usually about 1% of what the home is worth. And then after they do that, that's holding your money until your contract ends, until you purchase the home, okay? There's some other expenses for purchasing a home. You wanna have your down payment, which is usually 3.5% of the cost of the house. You wanna also have closing costs. You wanna have money for home inspections and appraisals as well. I'm gonna talk about some resources. Like I said, I was able to leverage my credit in first-time homebuyer programs to purchase a $422,000 house in DC using only $3,700. And the way I did that, I utilized a program called DC Open Doors and a program called EAP. So I work for the DC government for my 9 to 5. I consider myself a 9 to 5preneur, but there's a lot of different programs out here that you all can qualify for as well. One's called NACA, N-A-C-A. That's a really good one to get into a home. There's one that DC offers called HPAP. There's one called EAP. DC Open Doors, Maryland Mortgage Program. Your lender will be the one to be able to tell you about all these different programs. They will literally curate a package for you and say, hey, you qualify for this, 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 this. I was able to secure $38,000 from first-time homebuyer programs where I didn't have to take no money out of my pocket besides that $3,700 to purchase a home, and I don't got to pay them back until 30 years. I refinance the loan or I move out, okay? And I'm not doing none of those. And the beautiful thing about the DC market is already based on Redfin, which is a rough estimate, since March, my house is appreciated in value $54,000. So it's a win-win.